Abhisar, your fund has outperformed, of course, and congratulations on that. You're closing in on 1,000 crores, if I'm not wrong, in terms of AUM. What I want to understand from you, and correct me if I've made any of those statements which are incorrect, but give us perspective on what the rate cut means, because that's what currently is news of the hour. What does the rate cut mean for the economy, and what are those sectors in terms of which will get positive traction as a result of this? Because there will be some amount of influence, some amount of rub-off.
Thank you, Harsh, for inviting me to this show of yours.
Pleasure having
And
you here,
yes,
sir.
yeah, all your statements are correct. See, of course, the rate cut has been, pending for quite some time. It's a rate cut first time in the last 2 years now for us as an economy. And of course, it was correctly timed as per our assessment because RBI had its own set of things to balance. The growth has slowed down, as we all know, a little bit in the last 6 months to 9 months. And there are a confluence of global factors which are playing out in terms of the dynamics for the inflation. But having said that, Harsh, I think the rate cut is a step in the right direction. And from whatever I could make out from the commentary of the new governor, it seems that they will be more data driven and they will be growth supportive in terms of their rate cut measures going ahead. So in that sense, if inflation were to move in the right direction, which is downward direction, which they also expect, then there could be more measures around this front, to support the growth. Having said that, of course, the global factors will have their own play, and if inflation picks up, then the situation changes. In terms of your question on which sectors could benefit and how do we see that playing out, see, it's little early days, but what we have even seen from the budget is that there is a fillip for consumption to grow, and that to the discretionary consumption, because now you have extra in-hand income as a as an individual, and that is at the whole country level, because obviously at the lower income levels there is more money in hand for those guys, but even for the higher income levels, then the income tax cuts which has come in the budget is putting more money in the hands of the people. And now with this interest rate cuts, your EMIs come down, so you make that bit of extra saving. So I think that increases the potential for the people to take on a little bit more debt at the household level, and hence the discretionary consumption sectors, in our view, should get positively impacted. The lenders which support this should also get positively impacted, in my view, whether it would be the NBFCs or the banks, because the credit cycle can get supported. So that's how we kind of see it. But as I said, Harsh, it's little early days. This is just the first cut after 2 years.
Sure.
So we'll have to watch out for the data in the coming months.
Sure. Abhisar, very quickly, 30-second answer. Could you talk to us about how you've positioned yourself in the last 6 months?
Yeah, so see, Harsh, what we have been seeing that in the market as such is that while the macros have always been improving for India in the last 3-4 years, but the valuations have been a problem, and valuations have remained a little bit stretched because of the huge flows that have been coming in the mid cap, small cap thematic themes. So how we have positioned ourselves is basically a barbell strategy. On one side of the barbell, we have the value large caps, which sit out of places like banks, telecom, and life insurance. And whereas the other side of the barbell is the carefully selected small cap stocks, which are beyond the 400 market cap company and all the way to 1400, 1500 kind of market cap. These are from various sectors. We have done deep research and bottoms up, work on these companies, and then selected them from various sectors like hospitals, EMS, auto banks, and the like.
And therefore, does that strategy continue into 2025 as well?
Yes, very much so. Because see, though we have had some dislocation and around 3 to 4 months of correction, with which we have also talked about in our latest investor newsletter, more than 81% of the stocks are down 20% or more. But we believe that the valuation correction in some of the very stretched pockets could be long drawn. Okay, and it won't just get all the froth might not get cleared with just 3 to 4 months of fall at the index level. In fact, the falls are lower, the stock level, some of the falls are more. So we continue to maintain the same strategy where we are able to get good opportunities more in the stocks which are beyond the 400 market cap where the popular indices kind of end, because the flows are going into the popular indices stock and stretching the valuation. And with the Indian economy's dynamism and the opportunities that are opening up across sectors, we are able to find opportunities more in that bigger basket of that 1,100 stock starting from the 400 stock. On the large caps, of course, we do find a lot of opportunities in some of the sectors that I talked about, and hence that also continues, and hence the barbell strategy continues here.
And Abhisar, so therefore, give us two pockets where you feel valuations are stretched. And I won't ask for names, but two pockets where valuations are stretched and two pockets in the current market which look extremely interesting, because we've seen a bit of a correction as well in the last 3 odd months. And therefore, what is it that you're positioning towards?
Sure, Harsh. So see, the two pockets where the valuations look extremely stretched, though the fundamentals there have improved in terms of the growth outlook, but still valuations look very stretched. Are one is on the capital goods side, where we have seen an very tremendous kind of uptake and rally in the last 2 to 3 years as the outlook started improving. So some stocks on that side, on the industrial cap goods, we still see extremely stretched in terms of the valuation. We also see the valuations little bit stretched on some of the consumer companies and some of the EMS companies which are proxy to those consumer on the large cap side, on the higher range of the mid cap and the large cap side. So those are the places we still see, the valuation stretch. Of course, the current fall is making some of those valuations correct themselves, but it is still, on a higher side. On the places where we see valuations, a little bit more reasonable, is on the BFSI side, which is largely to do with banks and some of the NBFCs. We feel that the lending practices and the overall balance sheets are in much better shape. Even in the recent results, we have seen that the incremental asset quality stress has not come in much bigger way except the MFI space, but most of the NBFCs and the banks have done really well. So that space is good. On the auto Ank side also, while the auto OEMs are a little bit stretched on valuation, but on the auto Anks, it's a much bigger basket, a much broader universe to choose from. So there, I think for their growth profile and the quality, there are certain stocks and picks that we kind of, continue to get Harsh. So that's how I would put it in terms of the, two spaces to look at and two spaces to avoid.
Abhisar, in some pockets where valuations are stretched, for example, a cap goods, there's plenty of argument to say that the tailwind is strong. The order books are long drawn, and therefore the correct way to look at this is that execution will come. And therefore numbers will also come, and stocks will therefore re-rate fairly quickly. And growth is extremely strong. This year has been a tough year for some of those counters because capex on the government side has been delayed. But likely Q4 will see a push with regard to that capex, and Q1 will be even stronger likely. Are you also somewhere of that count that may actually play out in some of the smaller pockets, maybe not the larger pocket of government capex, but any smaller themes that you'd want to pick up to take advantage of that over the next 6 to 8 months?
Yeah, sure. So see, we are not negative on the prospects of these companies, given how India's capex cycle and the energy transition cycle, and even the demand growth which we are seeing in some of the sectors that they support, like the power sector. So we are, looking at those smaller pockets for sure, Harsh. We have recently even, in fact, taken a small bet in one company which supports the, power transmission cycle, and it is providing a very key equipment to the transformer sector, for example. So, per se, you will always find opportunities. What we are kind of seeing is that the bigger, larger industrial companies and the capital good companies have seen a massive re-rating ahead of time, where even a small disappointments in the earnings could make their multiples, come down. And hence, there when we would want to bet, we would need to be a little bit more cautious and more reasonable in terms of what we can assume, because obviously in these things, also the incoming data of how really the execution on ground for all these projects and the government capex plays out will also have to be seen. But yes, the smaller segments of industrial process related equipment, power equipment, or even heat exchangers, to that extent, those are the places where we are betting and trying to find a few winners.
Okay, so some views coming through, and of course, an interesting conversation. Thanks so much, Abhisar, for taking out time and speaking with us.